As many of you know, I've been a fund manager for a bit over 30 years now, and I think we're at a major turning point. I've been talking about this for a while. I've got a new book out called The Retreat of Globalisation, and I just thought I'd touch on it this evening on some of the major themes coming through. And most specifically on that, really, investment returns have been outstanding. We heard a little bit about Unilever, and it's an excellent company. Some big companies are good, some small companies are good too. But quite honestly, it's been a great period to make proper money for clients. And that's not just related to the fact that the stock market's been growing. The globalization of world trade may have added as much as 45% to world growth since 1990. But also, alongside that, we've had two or three other trends which have been very favorable. The flood of imports coming from places like China have meant that although the cost of perhaps your accountant or maybe your lawyers have gone up, certainly the cost of your cameras has gone down. And the combination of the low-cost imports plus some inflation in the UK economy meant that actually inflation has consistently come below expectations, and long-term bonds, this is the price of government debt, the yield you get on your government debt if you were to buy a bond, borrowing from the government, effectively lending money to government, would have been 10% perhaps in the early 90s. It fell to about 5% for a long period, and after 2008, when we had the financial crisis, interest rates were reduced from 5.75% to 0.5%, and that's where they stayed until recently when they've fallen to 0.25%. And so we've seen bond yields coming down, and this has been a very favorable thing. Anyone who held assets like cash or bonds have felt that they're not getting an attractive return and have moved on and have started to invest in equities and other factors. And that's been a big driver. Although the world growth has disappointed over the last 5 years, stock markets have gone up hugely, and that's because the valuations have moved up so substantially. So if you look at this, this is looking at the valuations of markets, the kind of P ratio on a forward-looking basis, and you can see this is just the main market, the all-share. There was a wobble, if you remember, 2011 when we had the worries about Greece and possibly some of the European banks going bust, but valuations have moved right up, and the FTSE 100 has come right the way through in very substantial performance. So it's been an outstanding period of performance. In fact, many of us could have just put money in index funds. If you put some money in an index fund, an all-share index fund, without costs, you would have been compounding at 9.6% since 1985. So it's been an extraordinary period for returns. And alongside that, you've had income. And income's really important for investors and savers. And income's been growing very nicely. And last year, income grew at about 4%. If sterling stays where it is, and the valuation of some of the dividends, particularly those paying overseas dividends like Shell, continues to be higher this year than it was perhaps at the beginning of last year, then you might get another 6% dividend growth in the coming year. So dividend growth has been very good. Investment returns have been very good. And while small companies have had a bit of a rough time, probably in the last 18 months or 2 years, partly because people have been worried about Brexit. Now we're in Brexit, people are worried about that. They've grown pretty nicely, actually. So the valuations have been disappointing, but the underlying companies have been growing pretty well. So it's all been pretty good, actually, if you look on the top line. The problem is that once you look under the bonnet, you start to find that things aren't quite so good. So this is looking at the sort of wobbles at the bottom end of the market. And bond yields in the UK got down to about 0.6% after Brexit. They started to go up, and that's not just in the UK, it's a long-term trend. So as I said, bond yields have fallen really for the last 30 years, but they're starting to go up now, and that is something of a headwind for all equity prices, all asset prices. We've got to be worried about that going forward. We've got to be thinking about what we can do about looking after our clients in future. The other feature is once you actually start to look under the bonnet in terms of the dividend growth, you find actually that dividend growth in the UK hasn't been as good as people think. The fact is that Shell pays its dividend in dollars. Most of its business is in dollars, and because of that, when you get sterling falling in value, as it has after the Brexit event, it means that anyone who's holding Shell shares will actually be paid in dollars, which is worth more in pound note terms. And so a lot of the dividend growth has been coming from the devaluation of sterling rather than companies growing organically. And if you take out that effect, if you just look at what's been happening in organic growth of dividends, perhaps over the last year or so, you find actually it was minus 1%. Long-term investment returns are not just related to valuations going up and such like. If you look at the long-term investment returns, they're just related to two factors: what initial yield you buy at and how much it changes. If you get dividend growth, you get capital appreciation and dividend income. Clearly, if you get capital losses, dividend growth being negative, then you get capital losses associated with dividends, you get a poor return. So at the moment, the underlying pattern is that world growth is largely stagnated. That's where we are. And when we look at dividends and the sustainability of dividends, we find that companies have actually continued to grow their dividends, but very much at the expense of their safety margins. Dividend cover is a form of safety margin. It gives you an idea of just how safe your dividends are and how much they can grow further. And you can see here that dividend growth, dividend safety was not too bad ahead of 2008. Clearly, some companies turned out to be much more risky than many people thought. The banks particularly cut their dividends very badly. A few other companies cut their dividends as well. But we had extraordinary change at 2008. Interest levels in the UK, going back over the last 300 years since the Bank of England was first set up in 1690, had never previously ever fallen below 2%. And yet, in 2008, the situation was so serious, we didn't cut to 2%, we didn't cut to 1%, we cut to 0.5%. Everyone thought it might not last very long. It did last. It's still there. We're down to 0.25% now. So the situation is not getting a lot better. World growth is not coming through in spite of this extraordinary change of policy. Alongside that, we had quantitative easing as a kind of form of creating money. Again, it wasn't expected to last long, but it's still with us. We're actually still doing quantitative easing in the UK. It's still happening in Europe. And so that's kept bond yields down, that's kept markets moving. But actually, when you look at it in terms of dividend cover, what's actually happened is we saw that surge of recovery in 2009-10 as places, as the benefits of that policy started to happen. But then growth didn't come through. Companies have not been investing. And because they're not investing, they're not getting cash payback. And because they're not getting cash payback, they're paying some extra dividends, but only doing so at the margins of safety. And you can see at this end of this chart back in 2016 that the margin of safety on dividends is as low now as it's been probably in the last 20 years. It's lower than it was in 2008. It's certainly lower than it was when we had the wobbles in 1998 when the Russians were looking as though they might go bust. So we've got some real headwinds up front. And what I was trying to do with the book, Retreat of Globalisation, is start to think about what we as investors can do to steer for our clients. We've collectively got a problem. Returns have been excellent, but going forward, the red lights are suggesting that we're going to have to be a lot more careful and sure-footed about what we do with our clients' money. Perhaps the most important slide this evening is this one here. It looks a bit boring, I accept that. The cornerstone of all investment return is taking some savings and allocating it to an individual company and allowing that company to get a cash payback on that investment. It's generally driven by productivity improvement. Cash goes into improving the software. We heard from EG how they're putting money into software and improving their software and getting customer. And as that comes through, they get a cash payback. And as that cash comes back, then they can invest in future growth. They can pay more wages to their staff. They can pay tax take to the government. And what we've seen since 2008, or there was a pickup in 2009-10, is that productivity improvement has flattened off. This is the worldwide productivity improvement. It's just not going up. It doesn't matter how low interest rates are. It doesn't matter how much QE we put on the table. Generally, productivity isn't going up. And if productivity doesn't go up, then effectively none of us make an investment return. So this is a worldwide feature. It's not just a UK thing. The UK is not a lot better than the rest of the world. But actually, world productivity has been falling to 2015. We actually don't know what the number is in 2016 as yet, but it's probably going to be down again. So this is a big challenge. It doesn't matter how imaginative the governments and other central banks are. Under the bonnet, we're not making proper money. And we've got to find a way of looking after clients in this environment. So when it comes to CapEx, CapEx is the main way we generate the productivity improvement. And when you look at across the world in all the different areas of CapEx, it's not in the areas you'd expect. About a third, or just under a third, of the entire CapEx spent by the world goes into finding energy and bringing out oil. The problem with that, of course, is that when you're a big oil company, you're going to do a big development in Brazil or the North Sea. You can put your cash in now, and you can keep putting your cash in for 10 years, but the oil doesn't come out for about 10 years, and anything can happen in 10 years. Look at the last 10 years. We've had this extraordinary period of change with 2008 and all the rest of it. So the problem with investing in some oil companies is sometimes the investment returns are so long-term that actually, when you get there, it turns out to be different. So if you look at this chart, you can see back in 2012, 2013, about 31% of all CapEx was going into the oil companies. The oil price was happily over $100. Unluckily for those investors and unluckily for those companies, oil price turned out to be $27 2 years later. So we've got to find areas where CapEx can go in, but more importantly, we've got to find areas where the cash payback is relatively short. And that's the great advantage. Some big companies can do that, some small companies do it, but the great advantage of small companies generally is they're more agile, and they're only looking to invest 5 and 10 million, whereas big companies are looking to invest 5 and 10 billion. And you have to take a view on Mr. Trump, you have to take a view on what's happening about China, whereas a smaller company can take a view about the local economy, about its local customers, about whether Mrs. May is going to be in place. So if you can find companies with cash paybacks shorter, more immediate, small companies which are really delivering productivity improvement, outstanding service levels, I very much back up what Elizabeth said on that. Service levels are going to be incredibly important because profit margins since 1985 have doubled across the corporate world, not just in the UK, not just in the US, but around the corporate world. And we're beginning to see that beginning to pour back. So the Retreat of Globalisation talks a lot about profit margins coming down. And the companies which hold on to profit margin aren't just going to be the companies which are investing, but also those companies which aren't just delivering good customer service, but outstanding customer service. And certainly the engagements I have when I meet companies is very much talking, not just about service levels, but how do you measure them? How do you know that your customers are getting an outstanding level of service before, and if it comes off, how do you know before they do that it's coming down? So mystery shopping programs, complaints register, Net Promoter Scores, all of these features are ways of measuring customer service, and I think companies, investors, need to spend a lot more time looking at that issue. The markets still have some opportunities out there. There's more opportunities to stock select going forward. I think index funds are going to get a lot more risky. Generally, very few companies have gone bust over the last 30 years. Even in 2008, many of the companies which got caught out were lucky because interest rates were cut, not just from 5.75% to 3 or 5, but it came down to 0.5%. A lot of companies which could have gone bust didn't go bust. I think going forward, if we get another crisis, and I think there will be a new crisis, I don't know when, maybe China will go into recession or something awful will happen in the future, but at that stage, we can't cut interest rates because they're already 0.5% or 0.25%. We can't really use QE because bond yields are already low. And we've seen it before, there's no shock and awe, and the government's certainly not going to run a bigger budget deficit. They moved from a budget surplus to a budget deficit in 2008, and they're still trying to get the payback on that. So we've got to find companies which are safer, companies with better balance sheets, which are able to take advantage of the weakness of others, but particularly companies which don't run out of money and have emergency rights issues. What we are seeing, though, is actually greater interest coming into the UK at the moment. Although Brexit is an uncertainty, none of us know how it's going to unwind. What is interesting, with the devaluation of sterling, we're actually seeing that not just many of the small companies have fallen in value, they continue to grow well, but in overseas terms, if you're sitting in the US, perhaps if you're sitting in Europe, you're actually looking in and thinking, it's not just these companies are cheap, but actually they've got overseas operations, and they've actually, in terms of my dollar's going a lot further when I buy a company in the UK. So we're getting actually a surge of takeovers. We're not very pleased with this, actually. We've had a lot of takeovers in our funds in the last 6 months. We're not very pleased because the companies themselves, even after the takeovers, in our view, are still too cheap. So we're generally saying, please don't take our companies over. Maybe there's good share prices today, but actually we think there's a lot more under the bonnet. There's only one case recently where most other investors fortunately also said no to a takeover, and it's a company called Lavendon. Lavendon is a company which is principally in the UK, but it also has a position in Germany and a couple of other countries overseas. It's heavily involved in those what's called cherry pickers, those kind of scissor lifts which come and replace light bulbs in places like here. They hire them out. They're very good at that. The management team came to see us. They said, we'd love to be taken over because we've got a great takeover price. It's about 50% up on the share price. You'll be thrilled, won't you? And we said, no, we think you're worth a lot more. Fortunately, other investors said that. The bidder still put £2 on the table. It was about 120 beforehand, so we got a big uplift. But subsequently, because we hadn't agreed and others hadn't agreed, there was competing takeovers. And the latest bid for that company is now £2.70, another 35% higher. It just shows how much value there is in certain parts of the market. Certain companies, you can find great value. And some of these other companies have been taken over, and we're generally disappointed with that. So to conclude, I think we're at a big turning point. This is not just a sort of change a little bit here. I think we're at probably the most significant period of change for the last 30 years. Really, the world has been very consistent. Nearly all governments, whether they be left or right, have been very positive on globalization for 30 years. But now that productivity isn't coming through, now that jobs are getting a little more uncertain, now that tax take's getting more uncertain, we've seen a profound change in social attitudes. And when people vote for Brexit, it's not because they don't like the Europeans. It's actually just down to the fact they don't like the way that globalization's worked for them personally, particularly in the last 3 and 5 years. And they're voting for change. They're voting against the status quo. And I think we can say exactly the same with Trump. It's not that he's a model citizen. Quite clearly, he represents change, and therefore people are voting for him. And we're going to see the same kind of pattern, though we may not see the elections leading to a change in government in Germany or France, but the agenda has changed. And because the agenda has changed, it means that politicians are now using economic policies which are different than we've seen for the last 30 years. And it's that difference in economic policy which means that the change in stock market trends is going to be different going forward. That means that all of us, particularly fund managers, we're going to have to get our steering wheels and be very, very sure-footed about what we're steering into. Buying index funds isn't the way forward. Going forward, we're going to have to be so much more selective about the individual stocks we select. But those which win will win disproportionately. Those which lose will lose disproportionately. And so going forward, we've got to be so much more careful about being sure about what we're investing in, particularly companies with safe balance sheets, particularly companies which are delivering productivity improvement, particularly companies delivering outstanding service levels. Thank you very much indeed.